$47 billion. That's what investors thought WeWork was worth. In reality, it was an office rental company losing $40 million every single week. September 2019. Adam Neumann stood before his employees with devastating news. The IPO that was supposed to make them all millionaires had just been cancelled. The company they had sacrificed everything for was worth a fraction of what they'd been promised. But how did a company that rented desks convince the world it was worth more than Ford, Delta, and Marriott combined? How did one man's charisma blind the smartest investors in Silicon Valley? The story begins in 2010 in Brooklyn. Adam Neumann was a 31-year-old Israeli immigrant who had failed at several businesses: baby clothes with knee pads, women's shoes with collapsible heels. He was looking for his next idea. His landlord had a problem: a building with empty space that no one wanted to rent. Neumann had an idea. What if they divided the space into small offices and rented them to freelancers and startups who couldn't afford traditional leases? He partnered with his friend Miguel McKelvey, an architect. Together, they created Green Desk, an eco-friendly co-working space. It filled up immediately. They had discovered something: people didn't just want cheap office space. They wanted community. In 2011, Neumann sold his stake in Green Desk and launched WeWork. The concept was the same, shared office space, but the vision was completely different. WeWork wasn't just renting desks. It was elevating the world's consciousness. That phrase would become a running joke. But at the time, investors ate it up. Adam Neumann was tall, charismatic, and spoke with absolute conviction. He didn't see WeWork as a real estate company. He saw it as a tech company, a community company, a movement. The venture capital flowed in. First millions, then hundreds of millions. Benchmark Capital led a $17 million round in 2012. By 2014, WeWork had raised $350 million and was valued at $5 billion. Neumann spent the money as fast as it came in. WeWork opened locations in city after city, country after country. Each new space was more lavish than the last: custom furniture, free beer on tap, neon signs with inspirational messages. The losses were staggering. For every dollar WeWork brought in, it spent nearly $2. But Neumann had an explanation for everything. "We're investing in growth," he would say. "We're building a global community." Meanwhile, his personal spending was legendary. A $60 million private jet. A $35 million house in the Hamptons. Surfing trips to Maldives. All somehow connected to WeWork's business needs, according to Neumann. He cashed out over $700 million in stock before the company went public, an almost unheard of amount for a startup founder. He also took out personal loans from the company, including one for $500 million from JP Morgan. But the most important relationship in WeWork's story wasn't with any American investor. It was with a Japanese billionaire who would pour more money into the company than anyone thought possible. Masayoshi Son was the founder of SoftBank and the architect of the Vision Fund, a $100 billion pool of capital, largely from Saudi Arabia, designed to transform the global technology landscape. He had made billions betting early on Alibaba. Now he needed new companies to invest in. In 2017, Son met with Neumann for just 12 minutes. He looked at WeWork's expansion plans and said they weren't ambitious enough. He drew a diagram on a napkin suggesting Neumann should think 10 times bigger. Then he invested $4.4 billion. Over the next 2 years, SoftBank would pour more than $10 billion into WeWork, pushing its valuation to $47 billion. It was one of the largest private investments in history. Son and Neumann shared something: an ability to see the future that didn't exist and convince others it was inevitable. The problem was that WeWork's business model was fundamentally simple and fundamentally flawed. WeWork signed long-term leases for office buildings. Commitments of 10, 15, even 20 years. Then it subdivided those spaces and rented them out month to month to members. If the economy slowed down, members could leave immediately. WeWork would still owe billions in lease obligations. By 2019, WeWork had $47 billion in future lease commitments. It was essentially a bet that the economy would never have a downturn. That startups would never stop growing. That office space would never go out of style. But inside WeWork, the culture was even stranger than the finances. Neumann ran the company like a charismatic cult leader. Mandatory attendance at summer camp retreats with all-night parties. Tequila shots at company meetings. Layoffs followed by open-bar celebrations. His wife, Rebecca, was given the title Chief Brand and Impact Officer. She once fired an employee for having bad energy. She told staff that her husband's ambition was to become president of the world. The Neumanns trademarked the word "we" and charged the company $5.9 million for the rights to use it. When this was exposed, Neumann gave the money back, but the judgment that led to the decision remained. In August 2019, WeWork filed its S-1 prospectus to go public. The document was supposed to convince Wall Street that WeWork deserved its $47 billion valuation. Instead, it became a symbol of startup excess and delusion. The prospectus contained gems like, "We dedicate this to the energy of we greater than any one of us but inside each of us." The financial details were even worse. WeWork had lost $900 million in the first 6 months of 2019 alone. The corporate governance was shocking. Neumann controlled the majority of voting power through a special class of stock. If he died, his wife could choose his successor. He had personally invested in buildings that WeWork then leased, a clear conflict of interest. Wall Street, which had eagerly awaited the IPO, suddenly woke up. Analysts who had valued WeWork at $47 billion slashed their estimates to $20 billion, then $15 billion, then $10 billion. Some said it was worth less than zero. On September 24, 2019, just weeks after filing to go public, WeWork announced that Adam Neumann was stepping down as CEO. A week later, the IPO was officially postponed indefinitely. The board, the same people who had approved Neumann's decisions for years, now acted shocked. Shocked by the spending. Shocked by the governance. Shocked by the conflicts of interest that had been hiding in plain sight. But Neumann didn't leave empty-handed. SoftBank, desperate to avoid a total collapse, agreed to buy out his remaining stake. The total package was worth up to $1.7 billion, plus $185 million in consulting fees. A man who had driven a company to the brink of bankruptcy walked away with enough money to never work again. Meanwhile, thousands of WeWork employees saw their stock options become worthless. In the months that followed, WeWork laid off 8,000 people, more than half its workforce. It sold off side businesses that Neumann had acquired, a wave pool company, a coding bootcamp, a building management startup. The empire was dismantled piece by piece. Then came March 2020. A global pandemic emptied offices around the world. The very concept of shared workspace, people crowding together in open floor plans, suddenly seemed like a health hazard. WeWork's losses accelerated. Its valuation dropped from $47 billion to under $3 billion. The company that was supposed to revolutionize work was now fighting for survival in a world where work had fundamentally changed. In 2021, WeWork finally went public through a SPAC merger. The same company that had tried to IPO at $47 billion was now valued at about $9 billion. The stock has continued to decline since then. Adam Neumann, meanwhile, landed on his feet. In 2022, he raised $350 million from Andreessen Horowitz for a new startup, this time focused on residential real estate. Some investors, it seems, never learn. So what can we learn from the WeWork disaster? First, charisma is not a business model. Adam Neumann could walk into any room and make people believe in his vision. But vision without economics is just fantasy. WeWork was never a technology company, it was a real estate company with a tech company's burn rate. Second, corporate governance exists for a reason. WeWork's board approved everything Neumann wanted: the jet, the trademarking, the related party transactions. When the company needed oversight most, there was none. Third, venture capital can enable delusion. SoftBank gave WeWork so much money that Neumann never had to prove his business worked. He could lose billions and still raise billions more. This isn't investing, it's gambling on charisma. Fourth, the music always stops. WeWork's model assumed endless growth in a healthy economy. The pandemic exposed just how fragile that assumption was. But even without COVID, the long-term lease obligations would have eventually come due. The WeWork story is ultimately about what happens when everyone wants to believe. Investors wanted to believe they'd found the next Amazon. Employees wanted to believe their options would make them rich. And Adam Neumann wanted to believe he was changing the world. In the end, it was just an office rental company that lost more money than almost any company in history. But for a few years, it was worth $47 billion because enough people wanted it to be true. If you found this breakdown valuable, subscribe and hit the bell for more business case studies and industry analysis.